My name is AJ. I'm the founder and CEO of Instarent. Instarent is a business-to-consumer platform, a property management platform for self-managing landlords and tenants. Also, I'm a committee member of the Proptech Association as well. Joining us today, we've got GRAEME CAPLEN and JETHRO COHEN, SquarePeg Capital and Innovation Bay. I guess the question on every founder's mind right now is capital raising, funding, extending runway. The markets have changed a fair bit since 2019 from what I think, what they were. So before we start, if I can get you guys to just do an introduction on, let's start with you, GRAEME, about Innovation Bay. How do you help the ecosystem, and just a little bit about yourself?
Can you hear me? Cool. Hi, thanks for having us. So yeah, GRAEME, my career sort of mostly as a founder. I'm sort of new to traditional employment at Innovation Bay. What I do, and I guess what's relevant to the room, is my role is founder scout. So I sit between sort of investment communities and specifically what's called the Horizon community, which is early stage investors, and founders, and I kind of translate. So I spend most of my days picking the brains of people like JETHRO, going, what do you look for? Why do you say yes? Why do you say no? And then I take that information and try and translate it into founder speak. You know, when you're talking to a founder who's got a million things going on, you're like, just say these 5 things in this order. So that's what I spend a lot of my time doing, and probably hopefully can add some value to the conversation.
Excellent.
First of all, guys, thank you so much for having me. I'm an investor at SquarePeg Capital. For those of you who don't know, we're sort of one of the big 3 funds in Australia. We've got $2.5 billion in committed capital, $4 billion in assets under management, and offices in Australia, Southeast Asia, and Israel. And Proptech is incredibly close to my heart. I actually worked for Mina, who presented this morning as her chief of staff, and then led ops at Different before I joined SquarePeg. I think on everyone's mind is, oh my God, what's happening in markets? VC investment has gone down. I think VC investment has sort of modulated back to historical levels, sort of back to what we saw in 2019, 2018. And I think in good news, there's an enormous amount of dry powder in the VC ecosystem in Australia to deploy into amazing founders solving really big problems. And so, hopefully you all come and speak to us, other investors at the end of sessions like this. I'm really happy to be here. Hopefully we can give some advice on how to navigate this perhaps slightly tumultuous period.
Okay, so you're saying the funding environment really hasn't drastically changed from 2019. Maybe there was a slowdown, but right now you're seeing it back to where it was.
So I joined SquarePeg about 1.5 years ago in what was and can only be described as an enormously outlier period in VC investment. Rounds were getting done in days, not weeks. You would meet an investor and 3 or 4 days later you'd have a term sheet. And the amount of capital committed to startups in Australia was at an astronomically high level. That was, in many respects, amazing for the community. It was also really challenging for the community because investors and founders were forced to make decisions much faster than perhaps they historically had been. I think what we're seeing is that rates have fallen in investment back to levels that are kind of more in line with historical trends. And so when we look at the amount of capital committed this year relative to 2018, 19, it's sort of on that steady upward trend with 2021 and parts of 2020 just being these incredible outliers.
Well, that's great to hear because, I think funding is crucial, especially for PropTechs, and especially the development landscape we have right now with the amount of software developers that's needed to get to the levels that successful PropTechs need to get to. So, GRAEME, is that the same that you're seeing out of the environment? Is that the funding environment, the current funding environment, and what's driving it? Do you think is it at the time where we came out of COVID, right? And then we had a lot of layoffs, a lot of development issues, a lot of PropTech struggling at the time. Now the current environment, do you think the VCs are actively looking at PropTech? Are they actively looking at investing into PropTech as well?
Yeah. So we're running an event in November focused entirely on PropTech. Yeah, there's a lot of interest. I think the money's there. If you look at even the 3 big funds and how much you've all raised just in the last 12 months, it's billions. It's the most that's ever been. I think in my experience, and so, Proptech, something I've been focusing a bit on in the last, few months, but across sort of all different industries and sectors, the money's there, it's just getting it. And I think the way that investors are looking at businesses now, it has changed. It's gone back to where it sort of used to be. And I think, when things like COVID hit, you see numbers of new business registrations go through the roof. So like my first business was out of the GFC. And that was the highest period of new businesses since the previous GFC. And then that's happened again. So all these companies have been registered. There's this funding blitz. It's like a heyday. And then it's just gone back to the way it used to be. But a lot of people have started businesses in the last 3 years, so they don't really know how it used to be. Yeah. It's sort of just gone back to what I'm more comfortable with, but the money's there.
Okay. How can founders be more confident today to raise capital?
Yeah, it's a great question. I mean, if I sort of take a step back and I think about PropTech generally, and if I think about the sort of core experiences you have in the property market, you're finding a rental and you're living in it, you're buying a property, you're accessing financing, perhaps you're trying to, I guess, measure the efficacy of a commercial portfolio. All of those things are still really hard to do. As a consumer, as an investor, as an owner, as a lender, I think we're still sort of very early in the push towards digitizing the kind of physical world that we all live in and interact with. And so I think one of the things I've noticed in this really tumultuous period of economic times is founders sort of becoming a little bit more conservative in their storytelling. They go back to early exit opportunities. They'll talk about they'll spend a lot of time outlining the very detailed market sizing analysis that they've done. I think if you kind of flip that question a little bit and you ask sort of what gets investors very excited, it's amazing people solving huge problems with a tremendous amount of excitement. And so I think to kind of answer the question in a very simple way, tell the story with the most amount of ambition and excitement and energy and insight as possible, because I think the risk in times like this, where raising capital is becoming more difficult, is that people go, well, there's a really clear exit opportunity at $300 million to X partner. Or, we've spent a lot of time thinking about the exact number of property managers in Australia, and as a result, that the market size is Y. I think what we'll find is that the most excitement from investors comes from the people who go, no. If we take a step back and we remember that all of those things are still really, really hard to do, I want to end that, I want to fix that, I think that's where the confidence can come from.
Okay, excellent. Great.
Yeah, you kind of said it all. But I think from my perspective, like confidence and working with founders comes from knowing yourself. So, I look at it as there's a founder profile you look for, there's a business profile, there's an industry profile. So I kind of get back to like the basics of that. In a founder, you want ambition, you want excitement, you want someone who wants to go to the moon, actually to Mars and beyond, because you got to do your 100x, right? So you need someone who's going to show and give you confidence that they can do that or that they want to do that. They're not going to step out at 40 mil. They're going to step out at 4 billion or whatever, or just like you spoke about an example yesterday.
Yeah, and I think an important thing to remember is like, I've never founded a $10 million business, let alone 100 or a billion or a $10 billion business. Like, building a business to $10 million of market value is fucking hard, let alone 100 million, a billion. And so my comment is not so much that people need to be, I suppose, elevating past the goals that they want. But the important thing to remember is that when you're speaking to traditional VC investors, that's what they need in order to justify a return to their investors. And so it's sort of relatively simple maths in the end. If that's not what you want to do and you don't want to grow a business to that size, power to you. You'll probably have a much more enjoyable experience. And so I think then the trick is just knowing who is the right investor to take you on that journey versus the sort of power law style outlier VC journey.
Okay. Leading to that, so what kind of information should founders be including in their pitches? No doubt you guys see hundreds or thousands of pitch decks, right? So what is a couple of things that stand out to you? Graeme?
Should I say, before we say everything again? I mean, again, like I just go back to basics. So, if I'm thinking about putting a business, which is basically my job, is finding the right people to put in front of a room full of very talented and experienced investors. They look at sort of the first two things they look at is the founder. So, they look all those things and it's, do they like them? Do they feel, so I actually weight the founder the highest. Because if they don't get through that gate, the rest doesn't matter. Actually, the second thing, which I don't know if it's as common knowledge, is they look at the industry. So is the problem that company's solving, is it one, is it big? Two, is it going to grow? So they don't typically invest in something that's big now that's probably going to get smaller over time. They want it big and it's going to get bigger. If you get through those, then they'll look at your business, right? So, and then at that point, you've got to have A's and B's and C's. And I think pitch decks are pretty common now, what you have in them, and it's just about how you tell your narrative. Narrative's really strong, it's big, it's ambitious, but then you've got all the numbers and all the knowledge and the plan to actually execute that. And if you do all of that right, so you got through all those impossible hurdles, then your terms and your deal that you're putting in front has to be reasonable. They're investing in businesses, they want to make a return. So you can't say, I've got this great thing, you can have this tiny bit at a massive price. So I'm raising 600 grand on 70 mil, like pre-money val cap on a safe to A that I don't even know when I'm doing it. You have to provide an opportunity. There needs to be timeliness. There needs to be a very clear opportunity where you're like, I need this and I need this now. And if you do all of those things, you might get funded.
Agree. I think perhaps sort of some of the things, if I answer the opposite question, which is like, what would I perhaps avoid doing, or what is not often the best thing to do? I think one of the things I notice, especially early and especially again in sort of tumultuous market conditions, is people undersell themselves. I think Graeme's point that most investors will look first at team, second at problem, and third at product and business model, like that is 100% true. And so people who put team introductions or unique insight about a problem at the end of a deck, a lot of investors just won't get there because they're looking at 100 businesses a week and they're lazy and they're not spending enough time in a slideshow. And so elevate yourselves, you're the most important part of the business. I think that the second thing about problem that I would just add is size of problem and velocity of growth of problem is important. I think something else that's really important that people don't talk about a lot is it's kind of like the pain of the problem. How annoying is that problem? There are lots of really big problems that I wouldn't spend money to solve. And so trying to find a way of actually explaining why is this big growing problem that's only going to get more meaningful over time so painful for the people that experience it is, I think, incredibly important. And then the third thing that I would perhaps avoid is spending like an incredible amount of time explaining market sizing. There are a couple of reasons behind that. One, it'll probably be wrong, and that's no criticism. It's just that it's impossible to get two people to agree on the size of a market. Two, the investor's going to end up doing it anyway. And so the threshold you're sort of trying to meet is this big enough? And the enough depends on the investor that you're speaking to. But I see a lot of people have incredibly detailed slides that explain the size of the business that they're trying to build. And then the final thing that I would absolutely avoid for certain types of investors is explaining exit opportunities. It's just a very fast way for a certain type of investor to know that it is unlikely to build the business that makes sense for their fund mathematics. And so looking for exit opportunities, most founders are always doing it. And that's great, that's fine, I'd do the same. Just leave it out of the slideshow.
Excellent. So we've come through a period where investors were sort of pushing each other aside to invest in Proptech. Do you think that's still the case?
I think that Proptech's a really hard word to get people to agree on what it is. Like, Proptech is not particularly homogenous. You've got software for real estate agents, you've got unique ways of accessing sort of debt capital, you've got, I guess, businesses like Different who are full stack service providers. There are so many different types of business in the Proptech world. I think some of those are still incredibly competitive from an investment perspective, especially that play in the realms of the sort of $8.1 trillion of money that moves around the property ecosystem. So the Proptechs that touch on fintechs, I think, are still incredibly exciting. Perhaps where things have become a little bit harder to justify for investors is where the size of return is likely to be very small. And so highly verticalized software solutions that only make sense in certain domestic markets, I think are less attractive today than they were a couple of years ago.
Excellent. Graeme?
Yeah, I mean, again, said everything, but it just, again, holistically in the market, I was having a conversation with a particular investor, does quite a lot, quite a well-known person, said this time last year, I would get a term sheet on Tuesday and I had to sign it by Thursday. And I could barely look at it. It was either there was there or, I didn't have it. Now I'll spend 3 months to 6 months with a founder. So, again, the money's there, the process has changed. So, yeah, and I think timing and that goes into round sizes, it goes into so many different things. Timing is really, really important.
Excellent. So last question. What is your advice for founders currently fundraising?
Two things. One, be thoughtful about the investor that you want to partner with. Not every investor is right for every business, and there are lots of businesses that make sense for certain investors that don't make sense for others. And so I think in this environment, just be really conscious that you want a partner who you'll work with for 10 years that understands you, your business, your ambition, and the sort of problem that you're solving. I think that's thing number one. That is probably more important today given the sort of extra investment in process that Graeme described. And number two, and I'll say it again, keep in mind that like the core parts of property still suck. Renting sucks, buying sucks, getting a mortgage sucks. It all sucks. And so when you're telling the story, like bring it back to what the really large problem that you're trying to connect to is. I think, Fred this morning spoke about disruption versus incrementalism. I sort of think about it a little bit more simply than that, which is if the change that you are making is really fundamental to the way that people will live their lives or engage with property, sell that version of the story. Don't sell the sort of today version of the story.
Excellent. Okay.
Yeah, I mean, all I would really add to that is just, more tactically in round sizes and runways. We didn't get to sort of say that. Now, it takes longer to raise money. If you're raising to get 6 months worth of runway, don't. They're going to, and if you're thinking, I should raise less because the money's there, it's just, you've got to tell a big story. So don't cut yourself down and say, I'm raising, because you'll close your round and then start your next one because you would have already run out of money. So yeah, raising, I guess we're hearing a lot around through this period, but how long is this period going to be? So if you can raise enough money to get you through 18 months to almost even 36 months, go
Agreed,
for it.
totally agree.
Yeah.
All right. Thank you for joining us, guys. Now, we can talk about this all day. But if any of the founders here, they want to ask some questions, I'm sure you guys will stick around. So
I unfortunately won't be able to stick around, but please feel free, just message me. I'd love to catch up with anyone in this room, and we can either talk about the business or just the market more broadly. Genuinely happy to chat to anyone in here.
excellent. Thank you very much.